Cost of goods sold. A company's cost of goods sold, or COGs for short, are the costs directly associated with the goods that the company sells. COGs are variable depending on how many sales take place, which means that if a sale does not take place, these costs are not incurred. For companies which sell customers a service, the figure is commonly referred to as cost of sales or cost of services. In this lesson, we will discuss where COGs can be seen on the income statement, and even the balance sheet, what type of expenses make up COGs, and the figure's usefulness in analyzing a company. We will finish with an example analyzing wide moat companies, Coke and Pepsi, compared to narrow moat companies in the competitive chemicals industry. COGs on the income statement. COGS sits right near the top of the income statement under revenue, as can be seen in Coca-Cola's 2018 income statement on the slide. The net amount of revenue minus COGS forms the company's gross margin, so the two figures are closely intertwined. Whenever someone is talking about the COGS or gross margin of a company, the other is always the missing piece after subtracting 100%. For Coke in 2018, the $11.8 billion of COGS represents 36.9% of sales, and that implies Coke's gross margin for 2018 was also 63.1%. That is, 100% minus the 36.9% COGS. So you can see, knowing either COGS or gross margin gives you the information to know the other. COGS on the balance sheet. The relationship between COGS and inventory is a fixed one that can even be expressed in a formula, as shown on the slide. The matching principle of accounting means that expenses must be recorded in the same period that the affiliated revenue is earned and the expense benefit is used up. For COGS, this means that if the associated good is not sold in the same period that the good was produced, the cost is capitalized on the balance sheet as inventory. When the product is subsequently sold, the inventory is reduced and the COGS expense flows through the income statement. This relationship of COGS can be expressed in the formula that COGS equals the beginning inventory plus purchases minus the ending inventory. COGS inputs differ by industry, but the fundamental determination is the same, and that is that COGS consists of the direct costs associated with the procurement, production, or performance of goods and services. The key word here is direct, which will get drilled into your head as we discuss a couple of the common industries. For retailers, COGS primarily is the cost to purchase the merchandise for resale, but also includes less significant costs such as freight, duties, and other non-recoverable input taxes. Discounts received on the purchase of merchandise, such as volume rebates or discounts for early payment, need to be deducted from COGS. For manufacturers, COGS includes not only the cost of raw materials for production and major pre-built parts purchased from suppliers, but also includes the little screws that put these parts together. Crucially, with manufacturers, COGS also now includes other items directly involved in the production of the final product. These other direct items include the direct labor for production workers, supplies used up in the production of goods and services, such as grease for the machines and masks for workers, the depreciation of property and equipment, and other overhead costs directly attributable to the production of goods, such as electricity for the factory and factory supervisor salaries. For service companies, COGS, now referred to as cost of sales or cost of services, mainly consists of the direct labor associated with performing the service for the customer, as well as any material used up in performing the service. If the employee has to drive to the residence of the customer, then the gas and depreciation of the vehicle should be included in COGS. If the company's business is software as a service, then items such as server hosting costs, customer support, and the amortization of previously capitalized research and development costs, similar to the depreciation for the manufacturer, should be part of COGS. It is important to note that selling costs, such as sales associates' salaries, are generally not included as part of COGS, but are instead included under operating expenses below the gross margin line. This is because these costs do not pass the test of being variable to sales. For example, if a store is open all day but no one buys anything, the sales associate's salary still needs to be paid, even though revenue is zero. So what information can be learned from COGS? Analyzing COGs can show operational efficiencies in production and pricing power over suppliers when compared to the amount of volume sold. If a company is able to produce or procure the same volume of goods for less than in prior years, or for less than competitors, this is an indication that the company has, or is gaining, operational efficiencies and bargaining power over suppliers. Taking into account revenue and looking at the net gross margin figure, we can also analyze the bargaining power customers have over the business and its products. For example, if COGS is rising and revenue is flat, this is a signal that the company is not able to pass along rising costs to the customer, and this is a signal of weak pricing power by the company due to favorable bargaining power of the customer. In general, a company with low gross margins is indicative of a business operating in a commoditized industry. Now let's move on to our practical example. As can be seen in the graphs on the slide, both Coke and Pepsi have great brands and bargaining power, as exemplified through their high gross margins, averaging 61.6% and 54.7% respectively over the past 5 years. Also notable is that the gross margin figure has a low standard deviation of 1.1% for Coke and 0.5% for Pepsi. As expected, Coke seems to command the stronger brands and pricing power of the two, with the higher gross margins. Both companies have a low standard deviation of gross margins and cost of goods sold, which signifies that they are able to pass along to customers price increases in their production processes because their brand power is so strong and the threat of substitutes so low. 90% of the soft drinks I can think of are either Coke or Pepsi products. Now let's move on to the competitive chemical industry for an example of what lower and more volatile cost of goods sold look like. We will look at companies LyondellBasell and BASF for examples. As exemplified through their gross margins averaging 17.9% and 28.8% respectively over the past 5 years, the chemicals industry is competitive, with dozens of major competitors producing the same or similar products. The fact that BASF has higher gross margins may be indicative that the company is selling more specialized chemical products. Also of note is that the much higher standard deviation of 2.8% for both companies is evidence that they have less bargaining power both in their relationship with customers and suppliers. The conclusion from our cost of goods sold analysis would be that the chemicals industry is more commoditized in general than the beverage industry. The takeaway for analysts and investors from this lesson is that COGS can be a powerful tool in getting a sense of the industry dynamics and a company's position within it. To witness the performance of a company with low cost of goods sold and great gross margins deteriorate is an indicator that sadly the company is losing its competitive advantage and economic moat.